Hi, everyone. Thank you so much for coming today. My name is Megan Morris, and I'm the Associate Director of the Sustainable and Impact Finance Initiative here at Haas. We've got a lot of students and alum in the room, but also some new faces. And so the Sustainable and Impact Finance Initiative is an initiative that really does everything with sustainable finance and impact investing at Berkeley Haas. We have 3 different student-run investment funds that invest real millions of dollars. So if you want to know about what we're doing, come up and find myself or our faculty director, Panos Panatukas, in the back of the room after this. We are one of the co-hosts of the event tonight, along with the Center for Responsible Business. I'll let Robert say hello.
Hello, everyone. Hello. And Panos was just identified, the faculty director of SAFE. Panos, would you kindly stand and just wave so folks know who you are? This is our kind Panos, one of our favored professors here at Haas. Welcome also on behalf of the Center for Responsible Business. We're proud to be a co-sponsor. We're proud to be good, close collaborators with SAFE. And we're happy that you're all here tonight. My name is Robert. I'll be in the back of the room. Megan, I'll turn it back over to you.
Thank you. And I am going to let our esteemed panelists and moderator introduce themselves. But if you want to come up, I'll just say everyone's names and their organizations. We have Julie Menter from Transformative Finance. Leo Freeman from Obran Co-op. Lindsay Smalling from Mission Driven Finance. Michael Brownrigg from APIS and Heritage. And Nicole Middleton Hollway from Natural Investments. And I'll hand it over to you, Lindsay.
Okay.
Does everyone have?
Can I borrow this?
Yeah.
That microphone
You want this one?
Unfortunately, but
But I can use this, right?
Yeah.
Yeah. Okay. All right. So now they're going to be really intimidated by me because I'm standing. But hi, everyone. I'm Lindsay Smalling. I am excited to be here with you all, bringing together such a great group. These are all, just in case you didn't know, this is like a world-class panel. You can't get this good of a panel on the ownership economy anywhere else in the world, to be truly honest with you. These are all elite folks in this space, so get ready for that. I'm going to let them introduce themselves to kick us off, but I asked, since we are in this student-filled environment, and because we all have our own sort of career path and story, I asked them to do their introductions by way of sharing how, in Cliff Notes version, they got from being a student to being a leader in the ownership economy, ending up with where they are now. So, Julie, can you kick us off?
Sure. Yes. Hello, everyone. Julie Menter at Transformative Finance. I'm originally from France, where I got an MBA. And at the time, I was like, ooh, I'm going to go learn business skills and then take them to the nonprofit world, because clearly the reason problems aren't solved is that nonprofits are inefficient, which you can tell now I'm a child of the 90s. You know, it was like very like neoliberalism at its peak. So I, did business school. I did consulting, felt like good finishing school. At which point I realized actually a lot of our problems are related to businesses and how they operate and how they make decisions and how business cases are made. And so that's kind of the journey I've been on. After being a consultant for a while, I was an investor, investing in startups, and just got frustrated that I was investing in all these very cool companies that would get acquired and then crunched, all of their mission destroyed. And so I ended up crossing paths with Transformative Finance that was at the time kind of working on that same question of how do you structure companies differently so that they make different decisions over the long haul. So that's been the work that I do. And now I have the really fun job of learning about interesting things and then writing up long reports about it that hopefully some people read and then telling the world about them. So yes. Look at it, so beautiful.
I read them.
Yes, so that's how I got here.
Hi, y'all. Thanks for coming. What a beautiful Julia Morgan-inspired room. Leo Freeman, I use he, they pronouns. I'm based in currently unceded Nisenan territory in Sacramento, but I used to live right up the block. I got into this work because I studied jazz trumpet pedagogy and then naturally became a financial advisor. There's probably nothing I think that really like brought me to this work more than my own personal values. I think over time I had this like separation of in the early days thinking like my personal values and my sort of and my political values, I would say, were not aligned with like professional values or hopes. And over time, as I navigated the world of ownership economy, of cooperativism, of social movements, organizing in grassroots movements, Food Not Bombs here in the Bay when I was 18, really got sort of a taste for like social change work. And over time found that like through the true blessing of finding places like Addisina Social Capital, running into folks like Rachel Robichaudi, Maya Phillipson, people who sort of showed me like, no, like this work is possible. And finding my people, I was able to see myself in this place and not just be in the, sort of in the wealth hoarding of being a traditional financial planner. And I'm back in the day, the Robichaudi and Phillipson days, I also met Nicole. And so I feel really grateful for those folks who've like helped me see that like cool people are here and we're doing cool stuff. I won't bore you with the long version of it, but I will say that the way that I got here in this sort of current scope is that I kept showing up and I kept kind of being grouchy. That's something that I would say, like, I'm a very joyful person, but I'm also somebody who's really like, I have some really serious values. And I think that those values are rooted in anti-capitalism, anti-patriarchy, true like trans queer liberation. And that really runs sort of like the show for me. And that's something that we'll talk a little bit more about in like ownership, but folks in particular, like marginalized folks, having a seat at the table is what really brought me to ownership, and not just sort of by token, but kind of intention and purpose. So excited to be here. Thank you. I'll pass over to Michael.
Thanks very much, Leo. So that this is okay if I hold it right around here.
Maybe.
I am not an expert. Okay, good. So I had an unusual path to impact. I started as a U.S. diplomat, and then I moved in the mid-'90s through 2000 into private equity in China. And so I became deeply familiar with the Chinese history of that period. And what I saw happen was more people lifted out of poverty in a shorter amount of time than any time in the planet's history. And what struck me about that was if you can point the market in a good direction, you can do things at scale that probably philanthropy can never pull off. Not everything is subject to a business model. Nobody should try to make $1 out of a soup kitchen. But when you can generate returns and do something good, you can have enormous power. And the other example I always like to cite is Muhammad Yunus and Grameen Bank. If you had asked any financial expert back in the 80s whether the capital markets for 4 women basket weaving cooperatives in Bangladesh would be surplus cash, the answer would be absolutely not. And he showed that model can work, and now there's hundreds of billions of dollars in microcredit in all sorts of sectors around the world. So that's a really powerful model to me. We'll talk later on about ownership and what we're doing at APIS and Heritage, but for me, I'll finish with this idea, which is, so I started one of the nation's first impact merchant banks back in 2009, Total Impact Capital, very proud of that. So I was doing impact when you still had to explain what it was, in the first couple of years of SOCAP and that kind of thing. And the ability to find an investment that actually generates even close to market rates of return and does something meaningfully good is a unicorn. And I use that term advisedly. Like, I think there are fewer of those unicorns than there are of the software unicorns that you read about in the paper. And I think we're lucky enough to have one of those models. Over to Nicole.
Wow, thank you. Hi, everyone. I'm so glad to be here. Nicole Middleton, Hollway. I'm a financial advisor. I actually grew up right down the street in Oakland, and proud daughter of a cow bear. My mom, Teresa, sitting right there. So I found my way into this work. This is actually my second career. At the end of my 20s, I took a break. I did a sabbatical, did some travel, and did some soul searching, and came back really wanting to focus on economic empowerment for women, for people of color. I was really frustrated with my own lack of financial knowledge, and so I started. But I really wanted to work in that impact area, and so I went and worked for a women and girls nonprofit and was in a fundraising role. And that fundraising role really showed me that I really wanted to be more influential in where capital flowed and really pinpoint who were the decision makers. And wealth advisors, financial advisors are one of those advisors that have a lot of sway, a lot of influence in where money moves every day and where investment goes. So I decided, I wanted to go to business school. So I went to Golden Gate University, got my master's in finance and financial planning, became a certified financial planner. During that time, I got hired by a traditional Wall Street investment management firm, wealth management firm. And that experience was shocking to me, how I was like, if I stay in this work, I have to figure out how to do it in line with my values, with a group of people that I share, genuine, I like working with, that care about doing good work in the world, that care about equity and inclusion and all these things. And so I went and started a practice and struggled in the first several years of building a business. But luckily, through being very intentional about finding my people, as Leo was saying, I was really lucky to find a core people that helped introduce me to natural investments. And so now I'm here representing natural investments as a trust steward, and we'll talk more about that. But being a financial advisor, I love this work. I love what I do, and we'll talk more about it. But happy to be here. Awesome. Okay, so now I want to get to know you all just a little bit better. So just a quick show of hands. How many of you are students? Awesome. Okay, how many of you would say you work somehow connected to impact investing? All right. And how many of you work specifically in something related to the ownership economy, or you were ever a part of a co-op or... Okay. All right. So now we know who's in here. All right. So even though a lot of you may sort of know this, I found some of the numbers that were thrown around on our prep call sort of impressive. So I was hoping, Julie, since you were a big part of writing that report, you could give us sort of just a quick lay of the land on what is this ownership economy opportunity and how big is that market?
Yeah, sure. Okay, I'm trying. Was this? No. Okay, I have to hold it. They're tricky. You have to too loud, not loud. Hold it, perfect. Okay. Yeah, so how big is it? So I think for this conversation, we're focused more on employee ownership, and those are some of the more specific numbers I have, recognizing that what people put under the umbrella of ownership economy has multiple sizes. There's employee ownership, there's shared ownership of real estate or community ownership of real estate. Some folks also think about just owning of stocks in companies. So it has multiple variable sizes, but focused on employee ownership. This, and you all, there's a copy of it over there, but looking at numbers that Rutgers put together, the Rutgers Center on Employee Ownership does a ton of research in this area. They think there's about 1.2 million companies that could potentially be converted to employee ownership. Those employ a third of the U.S. civilian workforce, so that's a lot of people. And that if we were to take 20% of those and we're able to convert them to employee ownership, and then using a bunch of assumptions, which a number of you all weighed in on, that would represent about $1 trillion in investment capital that could be productively deployed. And think what's interesting about this number is less like, is it $1 trillion? Is it two? Is it half? Is that, I think it really counters this idea that like it's small. I think a lot of people think of employee ownership as like, oh, it's like there is Menti Co-op where I see them meet once a week and like, what even are they doing there? It's like, it's that, and it's also so much more. So that's exciting. I think the other piece is it's not just investment opportunity, it's also wealth for people. So if that $1 trillion were to get mobilized, it would represent about $3 trillion, again, lots of assumptions, of wealth for people. And that would be about $270,000 per worker in those employee-owned companies, which is really significant. You know, we think about those statistics of like 40% of people don't have $400 saved for an emergency. This is truly life-changing amounts of money we're talking about. So it's an exciting space to be part of.
Okay, and then just to dig into that a little bit more, I feel like I first heard the term silver tsunami from one of the founders of Transform Finance. He didn't coin it, but that's where I first heard it. But Michael, maybe you can just tell us a little bit more. What are these demographics of this moment that make that size and this moment important?
So it's pretty simple. Baby boomers own 40% of all the businesses that have 5 employees or more in the United States. Speaking as a baby boomer at the tail end, I just want to underscore tail end. We're not getting any younger. And if you talk to many wealth managers and advisors, they'll tell you most business owners haven't even begun to think about succession. In most cases, the children don't want to take over whatever the business might be, and they keep going until finally either health or a spouse says it's time to move on. And those decisions are right on top of millions of business owners, which is partly the numbers that underscore Julie's really great analysis.
And Michael, since you didn't introduce it before, maybe you can just share a little bit about specifically how APIS and Heritage is part of this silver tsunami transition?
We'd like to be. I'll try to shorten the origin story, but one of our founding partners had been working to help owners figure out how to do ownership transitions and found it was incredibly difficult. And it is incredibly difficult. The way for 50 years we've expected an owner to sell his or her business to his or her employees was basically not feasible. So if you're in your 60s and you finally decided to sell and you try to do what I call a do-it-yourself ESOP, basically financially what you're going to be able to do is take 1/3 of that company's value, your company's value, off the top, and the other 2/3 you're going to have to hold in a note for up to 10 years. So I'm here to tell you, if you're 60 and you're an entrepreneur and you're told most of your net worth is still tied up in the company for 10 years, that's not retirement. And so that's just not feasible. There's a whole lot of other paperwork that goes with these transitions, which put people off. In the 6 companies that we've done so far, none of the owners but one had heard of employee ownership, and every one of them cried at the end and said, I can't imagine selling my business any other way, but I couldn't have done it without the help of APIS and Heritage. So what we do briefly is replace that seller's note. The big aha moment for Todd, and then we built on it, is don't ask the seller to hold 65% of the value of the company for 10 years. We'll put our money in as a loan. We'll take care of that. The owner gets 90% of the value on day one. He gets to be a hero. He gets to retire and go see the grandkids. And we work with the company to transition it into a fully employee-owned business, et cetera, et cetera. I mean, there's a lot more steps, but, and it is a really powerful time. One of the reasons that we are in doing what we're doing is because we want to use this tool right now to lift up working folks who would not normally have a chance to benefit from ownership. And we talked offline about home ownership, increasingly out of reach to people. If you look at hourly wages in the United States, they're basically flat for the last 35 years, where all the costs, especially housing, has gone up. So the reason people don't have $400 saved is the same reason that 49% of Americans tell the census they have nothing saved for retirement. If you're living paycheck to paycheck, you can't save. And what this model does is help you own a piece of a business that's growing in value. You get more shares every year. Can I tell one quick story?
Yes, well, you do. I'm going to close that door because I love the bells, but they're a little distracting.
So
I thought I was the only one hearing it.
There's any number of great employee-owned companies, and you guys, read about them. Recology Waste, if you guys have Recology, they are 100% employee-owned, billion-dollar company. But a story that I really struck my eye about a year ago, the New York Times, ran a front-page analysis of the upcoming wealth transfer from baby boomers to their heirs. So that trillions of assets are going to get handed off, and inequality will probably grow as a result. And so it was your classic, well-written story about inequality in the United States and asset inequality in particular. And in the middle of this very long analysis, there is this anecdote, this story of this 53-year-old baker in Alabama, Leland Brawley. And the journalist writes, Leland is worried about his retirement. He's going to inherit the little shotgun house that his mom has. He'll get that. But otherwise, he's just holding tight to his $190,000 in retirement account. And the journalist didn't think to ask, how does a 53-year-old baker paid $20 an hour, $40,000 a year in Alabama have $190,000 in the savings account? And it's because he's an employee of Publix Supermarkets, which is an employee-owned business. That's the power of our model and what we're all working on.
Okay, so I want to go a little bit deeper on this idea that of the impact story. So I think Julie's touched on it, Michael's touched on it, but Leo, if you can just take us a little bit further in why is this an impact play? Like, why would this be something that if someone comes to this with the ideology and values that you all do, why is this compelling?
Ooh. I remember this question from our prep, but now I'm sort of like, there's 10 answers that I have. One, I think it's really aligned with kind of meeting the moment, and I think why now, which feels important, I think, particularly to bring the analysis of the, normally when I'm on a panel, I have to tell people what fascism is, but I don't think we have to particularly think about that right now. I have to explain it. But I think in rising authoritarian fascist regime, we have incredible pressure and responsibility to do things differently. And I think we have an example of that, what happens in the so-called Magnificent Seven, or I call them Maleficent Seven, on Wall Street. I think we're witnessing this aggregation and conglomerates taking over and shareholder primacy. And I mean, without going too deep on any of my gripes, I think there's a real opportunity, particularly to invest in sort of the fracture. Invest in this moment where I think a lot of people, regular everyday people, are waking up to the opportunity that is investing in something beyond just Wall Street, just beyond something that you know, something that you can recognize. So that's one sort of big why now in the moment. I think this other piece, and I think this is more speaks to the impact opportunity. I think that impact investors or folks, particularly with a political analysis or a social justice values or just kind of values around investing, I think that people are hungry for opportunities like this. I think people invest, and particularly as a financial advisor, someone who works with clients all the time who are really how do I make a difference? I got really moved in this work, kind of called to the carpet in 2020 after George Floyd was murdered and the social uprisings of 2020 in the summer. And ownership is, when we talk about ownership, we're talking about democratic decision-making. We're talking about having a seat at the table. We're also talking about what is the impact on individuals. And so to Michael's point, I think there's the individual wealth building, there's the community wealth building, but then there's also being in the practice of what is it like to cooperate? What is it like to embody the values of cooperativism and caring in a caring economy? So there's a framework called the Just Transition, and it was something that grew out of labor movements, in the 70s, 80s, 90s. It has been stewarded by a group, many groups, but Climate Justice Alliance and Movement Generation right here in our backyard in Berkeley, grassroots movement organizers who have been sort of sorry, I'll go, I promise, what was there? That have really brought this sort of like, we're moving from an old to a new. We're moving from the extractive economy to a new economy, to a living economy, to a regenerative economy for the people. And I think that a lot of investors have historically seen this transition, this conversion as really scary. And I think to Michael's point, and to think all of us who really are in the process of, there's a change happening, there's a transition happening, and there's a great wealth transfer. What opportunity do we get to have and do with that? So a lot of folks, millennials in the room, I'm on the edge too, but I'm on the upper edge, and folks who are, kind of not young enough to be in the sort of apathy generation, but I think a generation of people who are like really have access to resources but can't buy a house, or have future access to resources but they're being hoarded by boomers. I think we have an opportunity to say, like, well, what could we invest in now that could build institutions that would give us democracy and ownership and transition, close the racial wealth gap. And I think that the opportunity there is, how can impact investors show up in a way that's more alignment, more solidarity, and deeper sort of knowledge of what's happening on the ground and what folks need. And I think that's just like through relationship, through what Mike was sharing.
I'll just
Does that answer
trigger
the question?
one memory from the prep call. I think you also wanted to talk about intersectionality. And I think just to ground this a little bit more in like, why would generally helping employees own businesses, why would that have a gender component? Why would that have a racial justice component? What are the other components of it that I'm not even thinking of?
Yeah, thank you. I jumped ahead. See, I think so. I think when we, what I was really kind of educated on in this work early days was when I learned financial planning and kind of impact investing, I learned that everything was separate, right? We had themes. If you wanted to do alts, you wanted to do real estate, you were doing a theme of racial justice, but it was separate of climate justice. And I think as I've been in the process of, I worked at a community loan fund, and particularly took non-extractive investments of investors and deployed them into worker-owned cooperatives across a national network in the US called Seed Commons. And inside of that work, I learned that, like, the folks closest to the issue or closest to the solution, often furthest from the power and furthest from the financing. And that sort of, I think that's Angela Davis. I don't know who said that, but that's a quote, sorry. I think, to me, the intersectionality, and I'm curious what other folks think about this, but the intersectionality for me is that there's those folks who are closest to the issue are also folks who are furthest, typically from the table, who've been marginalized from the decision making, are also, folks who are racially marginalized, gender marginalized, folks that have are facing economic disparity, but have some of those solutions. And I think it actually makes it an opportunity to invest time, energy, and resources in solutions that are really rooted in the ground. So thank you for the prompt.
Yes, and I think we'll come back to it even more because I think it's one of the things that maybe is sometimes harder for people to draw a clear line between the ownership economy and some of the impacts they've been focused on in the world. But Nicole, now you get to bring this investing piece in our title into the conversation. So can you help us understand, what does it mean to invest in the ownership economy? What are the type of investment options out there? And how are your clients sort of coming around to this topic as something that they're broaching that topic with you and saying, what can I do here?
Ooh, good, hard question. Okay, so there are lots of opportunities to invest in the ownership economy that are available for accredited investors, non-accredited investors. You can be investing in community-governed loan funds. You could be investing in a private equity vehicle like Apis and Heritage. You could be investing. Let's see. In real estate? There's many community organized real estate investments that are popping and burgeoning and organized throughout the country that are really great. And some examples of those would be like Kensington Corridor Trust in Philadelphia, right out here in our backyard, East Bay Permanent Real Estate Cooperative. There's some of these funds can be accessed through philanthropy. Like you can be making grants to some of these nonprofits, so nonprofit loan funds or nonprofit vehicles. So our clients are interested in the way that we build the portfolio and help bring these opportunities to them comes through like you have to do like it's a normal financial planning and like figuring out a portfolio design process. But what I would say is it's really helpful that if a firm, like if you're a financial advisor, like the firm has to want to be evaluating these opportunities, and there is just not enough financial advisors out there who are willing to do the due diligence on a fund like APIS and Heritage. I mean, our firm actually has access to APIS and Heritage really just out of relationship, but it's very much like, but besides that, typically only like big, huge institutional investors would have access to an investment fund like APIS and Heritage. So the firm, like we would like to be seeing more adoption and willingness from the middle people, like us advisors, who are helping bring these opportunities to our clients, to investors. But there has to be a willingness on the firm to do so. And but a place like Transform Finance has a whole list of all these different funds, and there's many alternative ownership vehicles, but you have to be able to kind of like narrow them down, figure out what investment minimums are, figure out if you are, as an investor, can you qualify, figure out like, are you okay with like lockup of funds, and or would you rather be investing in like a Calvert Impact Capital note that would maybe invest in APIS, that does invest in APIS and Heritage along with many other funds. So that's just a short way to say the opportunities are vast and more are coming out every year. So if there is some serious interest that you have to be investing in these vehicles, they are out there. And if you are working with a financial advisor, you should ask them to look into those vehicles for you.
And would you say the demand for things like this has gone up as well? Or how are you seeing sort of just general interest in the ownership economy change?
Oh yeah, it's big with clients. It's big with our clients. It's not a hard thing for us to. They would like that. These are some of our like the seed commons and these kind of vehicles, shared capital in the Midwest. These vehicles are popular, at least with our client base. But we do serve a specific type of clientele that are like you, very interested in this topic and interested in investing in this space. Awesome.
Can I just add?
Please.
So it is the case, though, I think, I wonder if you agree, Nicole, but it is the case that when if we're talking about sort of high net worth individuals and small and family offices and things, going to those people and saying, here's a way to own an asset and you're going to make money and they're going to make money. It just means that the financial investors in New York, they're going to be the ones who don't make money, but the employees will and you will. Most of that wealth came from business ownership. Like, they get it right away. This is one of the simplest propositions I've ever had to explain in the impact space. I mean, my mom got it in like a sentence, So that's powerful, and it makes it easier to talk to holders of capital about why this model might work.
Okay, I want us to dig into a specific use case of natural investments actually becoming an employee-owned firm. But first, I want to just dig into one more thing with you, Julie. On the call, you made an interesting comment about how when you get groups of folks together for your research, that you can't really assume that everyone has the same idea in the room about what we're trying to achieve by investing in the ownership economy. Can you say a little bit more about that, just like what that range of objectives are through these types of models?
Yeah, sure. I think there's a lot of value in these broad terms, right? Ownership economy or employee ownership. And there's a lot of alignment in terms of the top line. We need to address inequality, for example. We need to But then even if you get to like the next level down, are people thinking about just really the, people having a little bit more money in their pockets so that they too can participate in the great glory of capitalism and invest in the glory of appreciating assets? Or is it because they're thinking about a radically different way of organizing themselves and the economy and being able to make decisions together and really collaborate and work in a different way? And those are actually quite different. And those are both employee ownership. And that's totally fine kind of at the top line level. I think there's a lot of power actually in having simple terms and in not necessarily getting into the like, well, I think, workers should have more power. I think really it's about raising the floor. I think actually it's about, more economic equality. Like there's a lot of internal debates within it. But I think as we're thinking about scaling and kind of this opportunity of $1 trillion, there's a real risk that some of these deeply transformational models get marginalized because the models that are more market rate, that are look more familiar to investors are the ones that are going to attract more capital because, you can get, it's like that unicorn model, right? One part of the economy is very much like you make money, employees make money. It's really powerful, but it's not a solution for everything necessarily. And so that is, I think, a really interesting. It's like a good problem to have, right? It's like a great problem to have. Be like people are super interested, and I think as this scales, it's worth being really aware of like what parts are scaling, what parts aren't. Are we delivering on the reason that why folks, at least some part of the folks in this, what you were talking about, right? New economy, living economy, comes with a number of other dimensions that may not be part of it. So it's good. It's a good set of problems to have.
Okay, so I think it's always useful to hear, I think, Michael, you gave a great example of how it has traditionally worked for an owner to transition to their employees, but there are all these new models, and it sounds like Natural Investments has just gone through this process, and Nicole, you're a purpose trustee, is that what it's called?
Trust steward.
Trust steward.
Yes.
All right, here's our resident trust steward. Nicole, can you say a little bit more about what that process was like and what your responsibilities are as a trust steward? Does it deliver on the promise from someone who's living it?
Yes. So Natural Investments is kind of unique as a registered investment advisor firm. All the advisors, including myself and 29 to 30 other advisors at the firm, we're not employees. We are independent contractors with the firm. So we couldn't become an ESOP. We had to look at what was another vehicle, and we started the planning process back as a firm back in 2021 into 2022, and realized that like after working with the help of some wonderful consultants, that the purpose trust, the trust ownership model, the perpetual purpose trust ownership model was the most unique, was ideal for our firm because and so it took probably a year for us to finish it, but it actually wasn't that difficult of a process. But the reason why we as a firm were looking at converting into a perpetual purpose trust, it was because of a silver tsunami kind of effect. Like our firm and I was founded 40 years ago by 3 white men, and it, up until 2009 was still owned by majority all white men. So before the trust became a trust owned company, they had to figure out a way. Like the company had grown. When the firm was sold to the trust, it was valued at about $4 million. That would have been really difficult for any of the advisors that across the firm to be able to afford to be able to buy in and help the existing 6 owners who were were on kind of that retirement trajectory and looking for a way to like sell out of their position in the firm. So, but there were some other really key benefits to the purpose trust ownership. One of which was we were looking for a way to allow for more democratic decision making. So the trust vehicle enabled that. And then there's some other things as well, and then the profit sharing was an extremely important component as well, is that we were, as a firm, trying to lean into how do we share profits more equally? Like, we wanted to practice what our values were in terms of like business being a living system, and that we are trying, like, through the work that we're doing, we're here to be improving systems and businesses. How do we as a business do that? But also, we didn't want to come get bought out. So the other thing about our industry is, like, it's very, like, the mergers and acquisitions thing, like firms getting acquired, like, by, bigger Wall Street firms like Morgan Stanley and other things. Like, that is just like a normal thing that happens all the time. And so if that were to happen, the ways that we practice as advisors is so unique, but it would probably not likely be able to continue. So we really wanted to, as a firm, be able to use this trust model that says, like, in perpetuity, you can't change the mission and vision of the firm, and like the values that we hold and the way that we steward it is very, very much protected by this trust vehicle. So it was great and unique, and we completed that transition in 2023. So 2 years later, and as an advisor, I was elected from our advisors to be on what our leadership committee is now called, which is called a Trust Stewardship Committee. So I'm one of 7 members of the Trust Stewardship Committee, and we were able to do profit sharing across the firm for the first time this year. Not huge, but in the future, if the firm continues to grow successfully after we pay down some debt, because as a result of this transition to trust ownership, the firm had to take on debt for the first time in order to help pay off like the earnouts from the existing owners, the six partner owners that had sold to the trust. So, but that has been meaningful. And then just like the diversity of our leadership immediately changed, like, from a gender, from a racial perspective. And then it all, like once we leaned into that, it really does kind of change some of the decision making that we do as a firm. So I'll maybe stop there, but hopefully that's a good understanding of.
Yeah, I think it's super helpful to just ground it there. Okay, so we want to open it up to questions. I did sort of bounce around with these folks, and I assume they would have interrupted if they had a burning thing they wanted to say, but while you think of your questions, anyone have something they wanted to make sure they said?
Nicole said debt. And I wanted to just name a little bit about debt vehicles that finance. Can I talk a little bit about that?
Please.
Yeah, so I think like from the investment perspective, and there's a lot of great research. I think also if there's something that you take from this panel is that we're just like, we are products and standing on the shoulders of folks who've been doing this work for a really long time. So of course there's the research and the work of Transform Finance, there's Ownership Capital Lab, there's a lot of orgs that, shout out, there's folks that are doing this work, putting on webinars. There's a lot of places to learn about this work. And I think we're really in the work of normalizing it so that it's not like, we shared, it's not just like this alternative thing, this like very small slice of an asset allocated portfolio. But debt is a really important thing to think about. I'm happy to answer any questions about it, but thinking about financing the ownership transition. So whether that's a silver tsunami business succession plan, buying out the owner, whether that's funding a loan fund that then can finance the workers to buy out their boss, like however you want to look at that debt being really aligned and non-extractive, we can talk more about that, but like making sure that the investment terms are aligned with the repayment capabilities of the business and the workers. That's a key thing. So there's a lot of funds out there who will do that kind of intermediary work. We've mentioned a few here. I won't give any more examples so it doesn't get misconstrued as financial advice because I am a financial advisor. But I do think there's an important piece around the longevity of your investment, right? So So a lot of people also in this kind of like new economy of work are like, oh, I just want to dip my toe in. I want to try it for a year or 2 years. And it ends up being really extractive to the investments in my experience. So if you can find the combination of kind of like, this is something that is new, but it doesn't make it some kind of higher risk. One example I have is that when I was at Seed Commons in 2020 and 2021, 121 businesses in the portfolio, all worker-owned cooperatives. We watched in 2020 hundreds of thousands of businesses go under. 121 businesses in 2020 in Seed Commons portfolio. 120 were still in business at the end of the end of the pandemic. Sorry, like at the end of 2022. So I'd say that the largely in part because of the financing, it was really flexible. It was patient. They were in relationship and partnership, and there was the terms were really amenable. There's still a return on the portfolio. There's still investment terms. There's still maturity, but thoughtful relationship was really key. So it just made me think of it when I was thinking about taking on that debt. If you have extractive debt, then it forces the workers to, it extracts from those workers that you're trying to support. Thanks for giving me a minute.
Okay, Robert is going to be my
running
MC.
You are a challenge for me, so I'm going to go to the back. And if you'd kindly say, if you're willing, your name and where you're coming from.
Hi, my name is Natalie. I sort of have some inside baseball because I worked with Michael in a previous life in corporate communications, focused on employee ownership. I'm curious for all of you, given the space that ownership works has taken as an entity in the discourse around employee ownership, what your thoughts are, if you think that's better for the movement, that there is a central entity that has been very vocal and has the resources, or if you think that's perhaps maybe drawing too much attention to only one model.
You want to go, Julie?
Or I can start. So for those of you who might not know, Ownership Works is an initiative largely by private equity firms to allocate a small percentage of essentially the payout they get when they sell the company that they've acquired to employees. And that also comes with a lot of kind of ownership culture and various things like that. And they try to size it so that the employees, when that business is sold, get about like a half year's worth of pay, kind of as a lump sum bonus. So I've heard it referred to as like bonus ships sometimes, because the employees don't actually own, don't actually have a share. It's more of a phantom share. I think my concern around it has been is it cannibalizing dollars that would otherwise go to more impactful models? Are investors getting confused? And actually, I've talked to a number of investors I've talked to. They're like, oh no, people can tell the difference. It's like either you're going to have a private equity allocation, and this makes you feel a little bit better about it being a little bit less bad, or you actually want to do ownership and you actually want to work on addressing inequality, and then you're looking at these other models. So I think I've become a little bit less concerned that people are getting confused, and in general, normalizing this idea that giving, paying your employees more is a good thing and motivates them. I'm like, yes, that's a good thing to say. But I don't know.
I think that's well said. I'm reminded of what, President Biden used to say is, don't compare me to the almighty, compare me to the alternative. And, when it's private equity, the alternative is nothing. And so I guess our sort of pragmatic view at our firm is, if regular working folks get a big bonus as a result of this tweak to the private equity model, how can we be against that? Is it the same as long-run wealth creation? Is it the same as broad-based ownership? No. But it's better than the alternative.
UC Berkeley students, hands, questions, UC Berkeley students? Please, and if you kindly say who you are.
Let me just make sure I'm not too close to this. You guys are talking a lot about the sort of silver tsunami, and something that I've been thinking about a lot in relation to the ownership economy is in Silicon Valley, where it's a bit of a younger industry, and so you might not be seeing as much of I guess short-term pathway for sort of older owners selling off to people who are working in those businesses. But there is also pretty common practices of ESOPs in the industry already, right? Which is often capped beneath a certain percentage, but it's still they have a semblance of employee ownership there. What would you guys see as inroads for that moving towards a more worker cooperative or just broader, actually full employee ownership model than it is as it currently is?
Is the question about a partially owned employee company versus a wholly owned employee company?
Well, just like how, because if this were broadly just a movement across various industries, in Silicon Valley specifically, which might have some different sorts of nuances to it, what would be the pathway for specifically forms of worker ownership that start to involve like worker decision making, right? Things that go beyond just having small amounts of equity in the business and start actually being like, oh wait, we actually run this place.
So that's a really good question, and I think a lot of us wrestle with that in our space. I now understand the question. So the way Silicon Valley does stock options is, of course, a form of employee ownership, but there is a huge tension when the underlying owner is in equity, and that's in space equity, and they need to get a return from selling their equity. So at some point, they're going to be in tension with the workforce over the long term. Like so. To me, it's the most powerful thing you can do is see a frontline worker and give that frontline worker a sense of a better pay, better and more respect. And so it's not that decision making isn't important. For my sins, I'm a part-time elected official. Every one of my residents cares a lot about the health of my city. They don't all show up at city council meetings, right? And that's okay. They got their own lives to lead. So there are plenty of workers who want to be seen, they want to be paid, they want to be respected. They don't need to be in the boardroom. Like, that's just not their priority. And we want to make sure that happens, because when you see and respect and pay a frontline worker, the company becomes more productive, it becomes more profitable, it becomes more resilient. And so for us, that's powerful. And that's what happens when you do broad-based ownership. And then you actually train people in what it means. May I tell a quick anecdote to the power of this? So one of our companies is a commercial landscaper in El Paso, Texas. The commercial landscaping guys are the very last trade in for a new building before the building can get leased up. So there's a huge amount of pressure on these guys. The building's up, the parking lot's poured, come in, put in the damn trees and the bushes so we can lease the building. So they always roll to the new project with at least 5 to 10% more plants and trees than they need. And of course, in case some break or die or whatever, and of course, they then go back with an awful lot of trees. And they used to throw them in the dumpster because that was, the guys had already paid for them, so they just threw them in the dumpster. After about a year of being employee-owned with training, one of the frontline workers, the guy's planting the trees in the ground, went to his supervisor and he said, this is kind of crazy. We're throwing away these trees, and instead, we could bring them back to the nursery and we get 50 cents on the dollar. And the supervisor who was telling us that story said, I thought about it, and I realized it would take a little more time, a little effort, but it would absolutely work out. And they added $100,000 to their bottom line in the quarter. And what the supervisor said is, in the old days, that frontline guy, he would never have said this. What did he care? It wasn't his money. He just did a job and he went home. But now he cared. And in the old days, I wouldn't have listened to him, because I was trained to listen to the guys above me and tell the guys below me what to do. And now I listen to the guys below me. Like, that's powerful for real life, for people working hourly jobs. That means a lot.
I have one thing maybe to share just briefly on the Silicon Valley and tech. Like the equivalent, right, is the IPO for tech companies, and you can do all sorts of interesting things in IPOs, right? Generally, what happens is the founder gets the cool shares that have all the power, and everyone else gets the shares that get the money, but none of the power, and then all the things. But there's some companies, like this company, Ginkgo Bioworks, they issued these super powerful shares to their employees. And so their employees have these 10x governance shares, and they're only to active employees. So if you leave the company, they convert to Class A or whichever way. But that's a really cool model, right? That could be totally applicable in companies that are structured a little differently.
We have more questions than we have time. Can I just see a show of hands? I've agreed to more folks. And so what I'd like to do is we'll take your question, we'll take yours immediately after, we'll pull them together, and then we do a response. Work? All right. So you can't respond to this question immediately.
Hi, I'm David Bank with Impact Alpha. And just Julie, actually picking up on Michael's last comment and some of the other comments, if all the advantages of employee ownership are so compelling for the business, why would capital flow to the less deep models and not to the deeper ones that bring forth those kind of benefits? Like, isn't there a business case for the deeper employee ownership models?
Hold that thought. Here we go.
Taj with Full Spectrum Group, and a big fan of everyone here. Just to quote Haas graduate, our friend Kat Taylor, she on this question: if everyone owns a little bit of everything, and no one owns too much of anything, that's how we get to the good life. So that's one take on ownership economy. Obran, so we may not have time for this, but Obran is, I think of as kind of the distributed Mondragon of the US. So if you know what Mondragon is, find out. That's what Obran is. Excited for people to understand how a group of workers who came together with businesses launched a financial firm, Obran Finance, which you run, and that's a really interesting story in this context. Apes and Heritage, it'd be great to hear the size of your last fund and what you're raising for your next round of funds, because I think that gives people a good sense of how this sector is growing in relationship to this $1 trillion opportunity. And then the big kind of interesting question I have in relationship to the ownership economy for this best-in-class conversation is sometimes we're thinking about the relationship between worker and community ownership and platform cooperatives, workers, and customers. And in the context of the Silicon Valley example, to me, that is where the important thing is, workers relative to customers, relative to ownership, and what potential you all see for growth in this sector relative to those intersections: worker community, worker ownership, worker cooperatives, REI, right? Those intersections.
So we got a pile of questions here. Please sort it out for us.
I think, Leo, can you, because we didn't really do Obran justice in terms of explaining that pretty unique model, so could you do that in short form if you can? And then we can let your peers jump into some of those other future-looking questions.
Yeah, absolutely. And just thanks, David and Taj, for the questions. Imagine having a mentor like Taj James with a question like that. So Obran is a worker-owned conglomerate cooperative. So we have a group of businesses right now, about 555 employees across a number of different portfolio companies and verticals in the holding company. The cooperative has different levels of worker ownership. So we have a couple of home healthcare companies, we have a staffing company, and we have Obran Capital Advisors. So to Taj's point, that's the organization that I steward. And the goal and the dream is to bring in, succession planning, but also businesses, doesn't necessarily have to be silver tsunami, businesses that want to transition to ownership, but want to be in sort of a larger sort of vision of workers across sectors, having conversations about the impact of what, for me, inside of a financial services company, learning about healthcare and home healthcare, and how can I be a decision maker in that conversation? How can I learn about that sector? So I serve on the executive team of that organization. Happy to talk more about it without going into too much detail. But the thing I like the most about the model is that it's a really bridging the gap across sort of business as usual and this like cooperative economy. So I think to the point of like Ownership Works or some of these folks that I think are taking, and I'll leave judgment out, but I think there's some aspects of like inherent capital or capitalism. I think the goal of Obran is really to work toward a future where all workers have a say at different levels of membership, at different levels of decision making, inside of the decisions made in all sectors, and that's complex training for how to be in the world, which I think to Taj's point about community and where does this cross over, I think workers have the opportunity to practice decision making together. We have the same opportunity at town halls. We have the same opportunity inside of our communities. We have mutual aid opportunities. I think something that I know about myself is that being in the practice of making decisions together is the best way to make the best decisions. Thanks.
Yeah, I can maybe touch on this, where capital flows and why not necessarily to the deeper impact portions. Part part of it is there's one employee ownership models that has huge tax advantages that others don't. So that essentially from a math, like if you don't have to pay taxes, then there's more money to go around for workers and for returns. I think the other is the kinds of companies that get converted. So I think there's a really interesting tension of like, are we trying to convert companies where there's workers that are working in really terrible working conditions, but they're not very well paid jobs, that we're making, they're going to own a little bit more of a company that's not generating necessarily like a ton of capital, of surplus cash. And so then you're investing in those because those are really marginalized workers. But there's just not a lot of return there for investors. So it's a range of things, I think, that drive that math. And to me, what it comes back to actually is a lot of like, we don't actually have a standard set of metrics that we've agreed upon as a field. So when we say deep impact, like what I think, if you took us all in a room separately, we would probably come up with a totally different set of things. That's on my like wish list for next year, is to like us as a field to start working on that. Because I think would really help clarify things like, what about ownership works? We're like, well, on these metrics that we've all agreed upon, here's how they score. And then we'd be able to have more grounded conversations, I think.
Okay, so as closing comments, and with this great, pretty proficient audience, knowing the group you're speaking to, can you all just close with, if this sparked something for them, where what can this group do to advance the ownership economy? What's something they should look into? What can they leave the room with?
Sure. If you are lucky to have investment capital, extra capital that you can invest, look at it, like understand it, engage with it. Like, what is it that you are currently investing in? Don't act like it's just, don't close your eyes and just act like it's not there. Like, look and see what you're holding. Understand a little, you don't have to understand all the ins and outs of the funds that you own, but like, go to little simple tools. You can, if it's publicly traded funds, mutual funds and ETFs or things like that, there are tools online that you can go to, resources like Invest Your Values through As You Sow. Natural Investments has a heart rating tool. Like, see how things that you own, like, what is the environmental, social governance criteria? Like, how do your values align with those things that you're investing in? I feel like that is just like such the starting place number one. And then number two, go to places like Transform Finance. There are so many tools available online where you can go and see some examples of so many funds that are investing in the ownership economy, that you can find things that are accessible, that could be accessible to you and interesting to you, and see if you could possibly move some money there.
Well, first of all, I'm going to do a lightning round. So thank you for asking about our funds. Our first fund was $58 million, and we were oversubscribed, the only time ever in my history of actually having to turn people away. But that was our fund one. And our fund two, which we're in the middle of organizing, is a $250 million vehicle. And we've had very positive reactions in the market. We're very grateful to the number of investors who are interested in hearing more. And then to David's point, why isn't money pouring in? Because we do compete with private equity. So if the company sells to a private equity firm, that private equity firm will make more money for its investors than we will make for ours, because we're a debt product, to Leo's earlier point. We think that's the right way to do this. We think our interests are therefore aligned with the company, which I can explain afterwards if anyone's interested, but I think it's the right kind of product for these transitions, but it means we make less money. Now, here's a little takeaway for any of you in impact, and I say this with 15 years of scar tissue. If you are an impact equity, just like that, you then have to compare yourself, or rather not you, but your capital providers are going to size you up against whatever they could do with another private equity or venture capital kind of investment. You're going to be measured against that. That's an incredibly hard hurdle. Most of the venture funds can't generate venture rates of return. And so an impact venture fund is really going to have a hard time. And the reality is, I wish it were different, but right now, the number of holders of capital who are prepared to basically just get their money back and feel good about things, they're just not a very big group. There's a really big group who want to have their money doing something more important than just supporting the Dow, but they don't want to take a big hit to their returns for whatever reason. There's a lot of people in that group. So if you sit in impact equity, you have to compare yourself to the equity metrics. That's a high bar. If you sit in impact debt, which is where we are, we're measured against private credit funds. That's half of the rate of return that a venture guy promises. So I don't have to generate a 20% plus return, and you don't either if you sit in a debt vehicle. So something to think about.
I don't usually recommend resources, but I feel like we're at a school, so I'd say more resources. There's a great paper and framework called the Social Movement Investing paper out of the Center for Economic Democracy. It's 109 pages. I had Natural Reader read it to me out loud, so highly recommend. It shows a strategic alignment spectrum across a range of kind of resist and build investments, or divest, contest, and reinvest, kind of in this build world where we're talking about building the ownership economy and kind of converting from the kind of current extractive colonial economy to this, a world where we have ownership and we have like equity and cooperation. It gives you a good kind of set of metrics, to Julie's point. So it's like a starting place. It's definitely just a starting place, but it gives you a good set of metrics. And page 58, there are three, I told you I read it. There are three different comparisons across like an opportunity zone fund, a cooperative loan fund, and then kind of a traditional Wall Street ETF. I highly recommend looking at it and sort of seeing what are the different criteria, metrics, and the weightings of that. It's just a good way to put some nerdy metrics to it. And then on the completely other side, I would say read Cruising Utopia. It's a great queer futures book. It's a sort of like, what is the world you want to live into? I think definitely when you're sort of taking, we were talking about normalizing this, but it's a great book that it's totally unrelated to ownership economy, but it's really thinking about like living and being in the future. And I think some part of this work is really embodying those values. So it's a book that really spoke to me around that.
Just in case people didn't catch it, what was the report, the first one in the
Social Movement Investing? It's out of the Center for
Investing.
Economic Democracy, CED, so Social Movement Investing paper, yeah.
And Julie, the final word.
Well, I like this idea of like books that you can live into, and I'm like trying to think of one that the name of which I can't remember, but I'm going to add this to my list. I think, these are all amazing pieces of advice. Maybe one prosaic thing to add is there's a ton of things in our environment, of like businesses in our environment that are employee-owned that we just don't know about. And I've been having a really good time being like, King Arthur Flour, employee-owned, Publix. My friend was like, oh, I'm going to Publix. I'm trying to get coffee. I was like, did you know they're employee-owned? So build up your skill set, drop it in conversations. You never know where it'll go. I think mainstreaming it, make it seem much more approachable, widespread, I think will help all of us.
Before I turn it over to Megan to give us the final words here, Natalie, would you be so kind? We have a survey that we would ask that you would complete for some feedback on this wonderful session. And I would like to also draw our attention to two very important people who made tonight happen. Natalie right there, walking from the Center for Responsible Business, and Persis right there from the Center for Responsible Business. And you're pointing your fingers, so please.
Megan as well. Megan.
Well, I'm giving her the microphone. Of course, Megan. So please, Megan, bring us home if you would.
Thank you. Yes, everyone now applaud for me. No, just this was an amazing panel. There's so much expertise, of course, on the panel, but also in the room. And so I invite everyone to stay, our panelists and our guests, for the next half hour. We still have food, we still have drinks in the back. And so after the panel portion, we're going to transition. Just hopefully, if you didn't get a question answered, you can come and speak to the panel, and we'll be here for a few more minutes. But let's just give one more round of applause to our amazing panel. Thank you very much for joining us tonight, everyone.